CQS New City High Yield Fund, or NCYF, aims to maximise the income it can generate from high yield debt without taking excessive risk and while growing the dividend each year. Growing the dividend each year is a challenge with bonds, as their yield varies over the course of the cycle as interest rates rise and fall. But NCYF has achieved 19 consecutive years of dividend growth. So if it raises the dividend for just one more year, it will qualify for the ARC's Dividend Hero status. The trust yields over 8% at the time of filming. To achieve all this, the managers invest in specialist areas such as financials, and they also invest in less liquid and smaller issues. And due to those features alone, these tend to pay higher yields. Fewer investors analyse and research these smaller issues, and they're often unrated by credit ratings agencies. So there are value opportunities for those who have the experience and the expertise to do the research. NCYF is currently managed by Darren Toner and Ian Francis. Ian, or Franco as he's known, is stepping away from the trust next year, and Darren will then be sole manager. Darren is head of global high yield and financial strategies at CQS, so he's very well versed in areas in which NCYF is invested. The portfolio has long had a significant tilt towards financials, which make up around half at present. Banks have complicated capital structures and they issue lots of debt with lots of different characteristics on a regular basis. And this means they provide lots of opportunities for active managers who have the capacity to understand the industry and its complexities. Darren and Franco can invest in the smaller and less liquid tranches in financials, thanks to the closed-ended nature of the fund, which means illiquidity is less of a risk and the trust is of a size that it can take meaningful positions in such debt. Total assets are just under £400 million. The bank debt will include tranches such as AT1 debt or CoCos, i.e. contingent convertibles, and some of this junior debt converts into equities. And so understanding covenants and the whole capital structure is crucial to the research process. The managers will also, at times, in fact, invest in high-yielding equity to provide some inflation protection and some growth based on their reading of the balance sheet of the company. The portfolio is mostly invested in sterling bonds, with around a quarter invested in other currencies. These currencies are left unhedged, as hedging reduces the yield that can be earned, and as the unhedged currencies provide some diversification of risks, as well as at times some extra yield. Returns come essentially from the income earned. Although the managers will make some trades to attempt to capture capital growth, the strategy is essentially to buy and hold high-yielding debt in order to hit the ambitious yield target and to avoid reducing returns with excessive trading costs. As a result, the total returns over the past 5 years are more or less what you would have received if you'd reinvested an 8% dividend, although investors who had spent the income instead of reinvesting would have seen their investment fall by around 8%. Rising yields have created a headwind for fixed income investors, as the effect is for bond prices to fall. But if we were to see a period of falling rates, we would expect to see some of these losses made back in the NAV, although the high yield target would be a demand on any cash made from gains. Volatility is always going to be part of the story with high yield debt, and gearing of around 10% on average, and equity exposure of another 5 to 10% should increase NCYF's volatility. That said, the NAV was notably less volatile than the high yield market during the sell-off of 22 and the recovery in 23. We think this shows that the manager has been able to invest in the highest yielding parts of the market with the necessary stock selection skill to avoid exposing the portfolio to blow-ups and defaults even in stress markets. Of course, it's worth remembering that with coupons on high yield debt being so high, investors continue to receive a steady return when equity and credit markets fall. So as a result, in 22, when equity markets stumbled and bond markets sold off too, NCYF's performance was fairly resilient. The challenge for the managers is maintaining the yield target if yields in the market fall. They're very confident they can do this, and they point out that in the past cycles, they did precisely that. Lower yields in the market will mean that some borrowers will be able to raise debt who weren't able to when yields were higher. Plus the strategy of fishing for the smaller and less liquid issues, which larger open-ended bond funds and those with less specialist managers can't, means they expect to find plenty of opportunities. Ultimately, the sustainability of the yield rests on the team's ability to do the detailed analysis on riskier and smaller borrowers, those not covered by rating agencies, and to consistently make good stock selection and valuation decisions. And they have a good track record of doing that. NCYF trades on a premium, and the board are regularly issuing shares at a premium of around 5%. This is so high in order to avoid the costs of new issuance falling on existing shareholders, as there are higher trading costs and spreads to consider in the high yield debt market. We think this premium rating is sustainable as long as the yield target is met, and in fact, if interest rates come down, NCYF may seem even more attractive to a greater number of investors. However, new investors need to bear in mind they will have to hold for some time to earn back a premium of 5%. So in our view, this underlines that the shares are likely best suited to income investors with a longer term time horizon. For more information and to keep updated with CQS New City High Yield, head to the Kepler Trust Intelligence website.